2023 has been a great year for stock market investors, with the S&P 500 up about 25% this year alone. But we never know what could happen in the future, and 2024 could turn out to be quite a challenging year. So far, the economy seems to be holding itself together, but a lot could change for the worst in the next year. So as investors, we need to be prepared for any sort of market conditions, and that brings us to the topic of this video, which is somewhat of a beginner's guide to investing in 2024. So firstly, we'll talk a little bit about how to find the right investing strategy for you based on your personal situation, and then we'll go over some basic methods for researching some different kinds of investments. For a beginner investor, the very first and probably most important thing you need to think about is your reason for investing in the first place. Are you maybe a young adult looking to start saving and growing a nest egg for retirement? Maybe you're near retirement and are looking to maximize income off of your portfolio to cover your cost of livings, or maybe you're somewhere in between. For me, my reason for investing is just to build wealth that's going to allow myself eventually and my family that I may have to cover the cost of living expenses without really having to work all the time if we don't want to. So generally speaking, if you are younger and just starting out, you might want to consider investing more into stocks, also known as equities. And if you're older and nearer to retirement, some allocation to bonds or something else may be appropriate, but these aren't rules and certainly not recommendations. Just an example of how your strategy can depend on your goal and maybe some other factors as well that we'll discuss. Very similar to the discussion of goals, you want to have an idea of your time horizon for investing. If you think you're going to need the funds in your portfolio in just a few years, then you probably want to protect your assets by investing in less risky and volatile stocks. Whereas if you have a lot longer, say 20 or 30 years until you plan on using the funds, then more risky and volatile assets could be appropriate. It's also important to understand as well that risk and volatility aren't exactly the same thing. For me, my time horizon is fairly long in the decades, so I invest primarily in equities and even do some options trading, which carries additional risk as well. The next idea to consider is your risk and volatility tolerance. And by risk tolerance, I mean what probability are you willing to accept that your investment goes to zero versus what probability do you require that your investment doubles in, say, 2 years or something like that. This is really hard to quantify, pretty much impossible, but it is a valuable concept to at least think about and consider. Volatility tolerance, on the other hand, is also important, but it's largely an emotional measurement. So this means how willing you are to see your investment fluctuate up and down in value through the course of the investment. So if you can't stomach drops of maybe 20 or even 50%, then a complete allocation to equities probably isn't the right thing for you, because you can definitely see those kinds of fluctuations when investing solely in equities, and that could cause you to panic at the bottom or something like that and sell out right before a recovery happens. I personally have a reasonable level of risk tolerance, but actually a very high level of volatility tolerance. So I invest primarily in equities, but generally they're not super new companies that carry a higher risk of failure, such as startups or those that are unprofitable. It's also important to consider your time commitment that you're willing to give to the investing process. Investing at any level does take some sort of time at least, but you can choose to spend a lot of time or really very little time at all if you want to. For example, if you can only spend 1 hour per month researching your investments, you can definitely still be a successful investor, but in that case, investing in 50 different individual stocks probably isn't the best choice, since you're not going to have enough time to properly research the companies and stay up to date on their performance over time. And if you can only spend an hour a month on your investments, that is totally okay. Like I said, there are definitely strategies out there that will work for you, primarily some type of investment in a mutual fund, index fund, or exchange traded fund. For me, I spend probably a few hours per week on my investments, which includes research of new companies, staying up to date on the companies that I do own and continually assessing those, and then also making investment decisions on a day-to-day basis. The final major item to consider when choosing an investment strategy is how much and how often you plan on contributing to your investment accounts. If you can only contribute to your accounts once a year, then maybe you might want to consider not investing it all at once, since there could be good opportunities to invest later on in the year. But it's definitely a valid strategy to maybe just invest it all at the beginning of the year and then not really pay attention to it for the rest of the year, if that's kind of how much time you have to commit, like we talked about in the previous criteria. On the other hand, if you can contribute funds on a weekly or monthly basis like I do, then you can pretty much continually buy whatever investments you choose at your leisure. And this is the strategy that I use in most cases for most of my accounts. A similar strategy that is popular is to basically invest the same amount into a specific set of companies every week or month, regardless of what the market is doing. And that's called dollar cost averaging. My strategy is a little different, like I said, because I do make variations to that set investment based on the status of the market and my individual companies, how they're valued at that particular time. So those are pretty much the major items to consider when choosing an investment strategy, in my opinion. I learned a lot about these ideas and their application from Matt Farley, who does have a YouTube channel and Twitter page that I will link down in the description. And for full transparency, my general strategy is as follows. The majority of my investments are in index funds, and the remaining amount is in a small portfolio of growth stocks and then a slightly larger portfolio of dividend growth stocks. But virtually all of my time spent investing is spent on the dividend growth portfolio that I showcase here on the channel on a regular basis. So now that you have decided on an investment strategy, let's talk about how to go about researching an investment. So first, I'll briefly discuss some things to consider with index funds or mutual funds, and then I'll go into some items to consider when researching equities themselves. So if you are interested in investing in an index fund, you want to be sure that the expense ratio is very low, because an index fund by definition is passively managed, so the manager doesn't really do much of significance. Fortunately, there are many low-cost index funds out there, so you basically just have to find one that matches your strategy, and most of these index funds will kind of describe what kind of strategy they're pursuing. When it comes to actively managed mutual funds or ETFs, it does get a little more tricky. In this case, I still do favor a lower expense ratio, but sometimes in rare cases, a higher expense ratio can be justified somewhere between 0.5% and 1%. But in my opinion, anything over 1% is just far too high and not willing to pay. It's also important to look into the manager of the fund and try to see what their track record is in the past when investing in that fund and maybe other funds that they've been a part of or involved with. But probably the most important thing to understand with actively managed funds is how the fund makes its investing decisions and the mechanics of how the fund works. Some funds these days have pretty complex rules and mechanics as to how they work and invest, so you definitely want to understand exactly how that works, so that you have a good understanding of what you are putting your money into and can have confidence in that investment. So sometimes funds do have quantified rules that they follow based on the fundamental or valuation metrics of a business. So you can think of this like an algorithm. If a certain condition is met, then the fund will buy or sell a particular stock. Sometimes though, on the other hand, the investing decisions are completely up to the fund manager. In that case, you really want to understand how the fund manager may act in different situations and kind of what their goals and strategies are. And then from there, you can assess whether that's a fund you want to invest in, because ultimately in that case, you are entrusting your capital to that fund manager in the hopes that, either they preserve or grow that capital. So you want to be sure that that's going to work out well for you. Now, when it comes to stocks, it's even more exciting because you are the fund manager. So you have to do all the research and make all the investing decisions, but that does give you a lot more freedom. As a long-term investor, it is important to think of your investment as an investment in a company rather than just a ticker symbol that fluctuates on the stock market. And as such, you must understand how that business functions and works, which means being able to answer some of the following questions. How do they generate revenue? What do their expenses look like? What do the growth prospects of the industry look like? How have they performed during previous periods of economic growth and likewise economic recession? And once you get past this point, the analysis can vary based on whether the company is more of in a high growth phase or whether it's relatively stable. So if the company is in a higher growth phase, then you want to understand a lot about management and how management makes their decisions and what their track record is in the past, because management can have a really big impact, especially for a younger company. You also want to understand how much longer the company might be able to produce a high level of growth before it slows down, and what kind of their overall market looks like. Say they have already acquired 50% of the market. They're not going to be able to grow all that much more, because more than likely they're not going to be able to get fully 100% of the market. So there's really only so much more at that point that they can grow, and so the growth is going to slow down. Where if they have only acquired 1% of the market, then there's still a ton of room for growth ahead of them. Another thing that's very important to understand is the financial health of all companies that you invest in, and you can do this by analyzing the balance sheet. This is a little bit less important for high growth companies, since their balance sheet will typically be not as strong, but it's still important regardless, I think, and definitely a must for more stable companies, because the balance sheet is ultimately the bedrock of this type of company, and without a strong balance sheet, even slow growth will be very difficult. I have made videos in the past on how to analyze a balance sheet, so if you do need help with that, definitely check those out. There'll be a link in the description to that. And for slower growing companies, it's also very important to understand an approximate fair value of the company, and be sure that you are investing in the company near or below its fair value. Investing in an overvalued company is one of the easiest ways to achieve minimum returns over the long term in the stock market. There are a variety of valuation metrics out there, including the dividend discount model, discounted cash flow model, the PE ratio, and the price to book ratio. These are all useful in different situations, so I do recommend you learn more about them and understand which one you can apply in those different situations. There are tons of resources online that can help you learn about that, so I definitely highly recommend you do that, and then you can implement those valuation metrics into your investing strategy and research. So that is my brief beginner's guide to investing in 2024. Please remember, before you start investing, to think about the factors that I laid out and decide on an investing strategy that you think will work best for you. Once you've decided on that, then you can begin researching your investments and starting on hopefully a very fun roller coaster that will help you reach your goals, whatever they may be. I know I did discuss a lot in the video, so if you have any questions, comments, or concerns, I'd love to hear them in the comments below, and I'd love to help. And you're more than welcome as well to join my free Discord server and share some of those questions there, or just share any opinions you might have. There'll be a link in the description of the video as well. Thank you for watching to the end of the video. I really do appreciate it, and I'll see you all in the next one.